Hello, I'm Matthew Harris. 2014 has been a challenging year for emerging markets. I'm here with Paulius Kuncinas, Regional Editor of Oxford Business Group here in Asia, to discuss the next 12 months ahead. Paulius, maybe you could share with us a little bit what is driving investor sentiment at the moment and what sort of risks and opportunities exist for Southeast Asian nations?
Thank you, Matthew. Indeed, 2014 is turning out to be a very interesting year for emerging markets. We're really in uncharted waters as far as predictions and forecasts are concerned. In the good old days, whenever global economy was recovering, as we are now, emerging markets tended to perform extremely well because investors were looking for higher returns, risk appetite was back. But what we're seeing in 2014 is although Europe and United States are clearly showing signs of recovery, emerging markets are underperforming. In fact, investors are pulling back their positions, their available capital, and putting it to work in advanced economies. So it is a very strange phenomenon, which in my personal view is driven by short-term positions. I think as far as smart money and long-term capital is concerned, emerging markets are still where people are looking for substantial returns. And once this volatility eases, I believe that the countries such as Indonesia, Papua New Guinea, Mongolia, and Myanmar will be back in fashion.
So what you're saying is that it's monetary policy that's driving investment flows?
Precisely. We are in a cycle where we've just had 5 years of extraordinarily loose monetary policy. Every time that the Fed talks about tapering, withdrawing liquidity, emerging markets sell off. And this is a very uncomfortable situation for both central banks and investors. I think risk appetite is there, but unfortunately, when currencies are fluctuating, as we have seen in Indonesia, in Thailand, even Malaysia, investors tend to go to safe havens. And advanced economies, for better or for worse, still offer investors more stability. And this is why you've seen exodus from emerging markets. Of course, added to that, we mustn't forget the political environment has changed quite a bit. We have seen riots in Bangkok. There's an election coming up in Indonesia in 2014 in this year. And we have also, we're also looking forward to an election in Myanmar. So all in all, the mix of factors is keeping a bit of a pressure on investment appetite.
How do you foresee the investment appetite in Indonesia right now? Obviously, that's a very popular market for investors, one that you're very aware of.
Indonesia remains the pivotal country for Southeast Asia. It's what made ASEAN, Southeast Asia, so popular as an investment destination. We need Indonesia to grow at least by 6 to 7% in order to maintain the momentum. Unfortunately, in 2014, we have a couple of big headwinds. China seems to be slowing down and is comfortable with lower growth rates of around 7% in order to maintain inflation. And of course, Indonesia is up against a very important presidential election. What that means that a lot of structural decisions are currently on hold and investors are waiting on the sidelines. I think Indonesia is fortunate to have a very large consumer class, a middle class of 120 million people. It still has a lot of FDI, foreign direct investment momentum. So I'm comfortable with 6 to 6.5% growth. But in order to go over to the next level, to 7 to 8, we need more investment in infrastructure. We need a more liberal, more friendly investment policy, and fundamentally more stability.
Okay. And do you foresee with the current election this year these sort of policies being carried on, or can you make any of those sort of projections?
I think generally Indonesia Indonesian politicians certainly understand the risks. They're very well informed. There is consensus in favor of liberal policy. The biggest issue is building a one-party line. When you look at Indonesia, investors, the number one complaint is that policy changes too often. Decisions are made sometimes very quickly without further consultation, and that creates an environment of uncertainty. But as far as the general direction, as far as the conviction, I believe Indonesia is on the right track, and it just will take a little correction, probably some little more further turbulence to restore consensus in favor of economic policy.
Okay. And how about when we look away from Indonesia right now? Maybe you can give us a bit of an idea of where you think there are growth potential within the ASEAN region.
Absolutely. First of all, we have to get it very loud and clear to our viewers that our conviction view is that Southeast Asia remains the most interesting investment destination globally. Whether you compare it to China and India, or if you compare it to Latin America, or indeed the Middle East, or Eastern Europe, Southeast Asia offers best returns, best risk rewards, because it's a story of stability, it's a story of consumption, which is very important, it's a story of healthy balance sheets, so banks and sovereigns have decent balance sheets, so you have a lot of room for independent, what we like to call decoupled growth. You know, we look at Indonesia, it's only its trade to GDP is only 20%. So it has a consumer class of 120 million. So it can practically grow whatever happens. And indeed it did back in 2008, 2009, when the rest of the world was stuck in a recession. Indonesia was still posting 4% growth. And now we have also an additional driver, which is Myanmar. And one of the big surprises and my favorite stories of 2013, of course, was the Philippines, which managed to surpass even China in terms of its overall growth. And that is really a result of years of investment and reforms and opening up. Finally, the region has come together. And really, on the next 5 to 10-year view, we're very bullish on Southeast Asia. We're very bullish on ASEAN. And if I had to offer a top 3 picks, I would definitely highlight Indonesia, followed by Myanmar and probably the Philippines.
Now, 2 countries I didn't hear there were obviously Thailand and Malaysia. I mean, 2 middle-income countries that are obviously trying to avoid that middle-income trap. Also very much trying to break through the technology barrier at the moment. Maybe you could give us a bit of your thoughts on those 2 particular markets.
Precisely. When I say top 3 picks, I obviously was focusing on headline growth. But it has to be said that these countries are growing from a very low base. Myanmar, GDP per capita is only $800 compared to now almost 12, 13 in Malaysia, or indeed 45 in Singapore. So there's a huge diversity of, in terms of income per capita within this region. And of course, countries that are on a so-called higher plateau, such as Malaysia and Thailand, do find it more difficult to deliver consistent growth rates above 5%. It's normal, it's simple mathematics. However, both countries, and especially Malaysia in this regard, have ambitions to reach advanced economy status by 2020. The main constraint, as we all know and hear about, is you need to invest into new technology, you need to have a lot of R&D, innovation, and above all, human capital. And both countries, in some ways, in their own very different ways, have struggled to create this new pool of talent that it needs to traject it to the next level. And I think, you know, the intentions have been very good. I have to say that both countries have followed the blueprint that was given to them, that they tried and tested. But at the end of the day, I am a great believer in the economic liberalism that we've seen in, for instance, in the European Union. You need to, the region, what needs really is to open up the borders to exchange of capital and also labor and skills, especially high-skilled labor. Because right now, every country is pursuing their own policy, there's a lot of restrictions, and of course, we should also mention the education. The human capital depends crucially on education policy. And so far, a lot of money has been expended, a lot of effort into this sector, but we haven't seen the returns that we're looking for. We need to, again, my own personal view, you need to open up the sector to more competition, to more private sector participation, and set much stricter targets in terms of expenditure and performance.
How about in terms of coordination within the region? Obviously, ASEAN Economic Community will come into effect in 2015. Investors are obviously quite interested in that, but how does that play into sort of developing human talent and education across borders within ASEAN?
I'm a great believer ASEAN offers a unique historical opportunity for this region to really come together into a highly attractive investable bloc, economic bloc. It is historically, as I mentioned, a very fragmented region, both geographically, it's nations of archipelagos and thousands of islands such as the Philippines and Indonesia, you know, divided by water, culture, religion, income per capita, I mentioned. It's a really diverse, but also the beauty lies in that the historical destiny of this region has never been particularly disputed. The region sees itself, defines itself in economic prosperity terms. So there are no big ideological divides between the political elites. They seek to deliver growth and prosperity. And nothing has been more successful than opening the borders to trade, to capital, to harmonizing standards, because ultimately that way you create economies of scale, you encourage competition, you encourage best practice. And this is what we've seen in European Union after the fall of the Berlin Wall. Countries like Poland and Hungary and Czech and Slovakia, they really came from nowhere, from GDP per capita of sometimes 2,000–3,000, reaching 15,000 GDP per capita in a matter of 5 to 10 years. Extraordinary performance. And I think this region can really achieve the same. We do have some major challenges ahead. There is a lot of still, lingering protectionist trends. Every country has a sector that it wants to protect and defend. In Thailand, it's famously the financial sector, the banks. In the Philippines, they generally have restriction on foreign equity. Indonesians are very protective at the moment of their minerals and resource sector, which is perfectly normal. However, is deterring the integration process. And in Malaysia, we know that the automotives and agribusiness sector needs to be liberalized further. So every country has its one sector that it cannot give up. So we're getting very close. I believe they've managed to close almost 90% of different positions that they're negotiating. But the next 10% I feel are going to be tough. Okay. And this could potentially stall the momentum, the positive momentum we've seen. But having said that, I think investors now are paying attention, and there are a lot of companies moving into either setting up their headquarters in Singapore, in Kuala Lumpur, in Bangkok, and really seriously looking at this region as a whole, rather than each country on its own, as it used to be in the 70s and 80s. So ASEAN are very bullish on. I believe in the project, and I think investors should be paying even more attention than they are at the moment.
Okay, fair enough. Now, Paulius, having known you for a little while, I know that you're quite vocal about Abenomics and sort of this experiment in monetary policy. Maybe you could share with us your thoughts a little bit more on that and how this might impact Southeast Asia as a whole.
Indeed, I have been known to say that Abenomics could be the answer to all the problems and liquidity issues and capital access to capital for Southeast Asia. And the reason I thought that, and still continue to think, is that essentially what is going on globally, but also within the region, is that multinationals and advanced nations are building global supply chains. It started with automotives, with Toyota building factories in Thailand, in the Philippines, now in Indonesia. You have big consumer companies such as Coca-Cola, Unilever, who also, they want to produce modern supply chains, efficient logistics, and they're effectively supported by their governments through such measures such as loose monetary policy, access to capital. And I think it's a good thing for the region, because ultimately what we're now seeing is the new wave of Japanese sovereign funds, banks really getting involved into long-term capital projects, crucially in infrastructure. I know they've been quite cautious, and it has taken longer than I thought it would. Sure. But you are now seeing projects really taking off in such as MRT project in Jakarta. The Japanese investors are looking very closely at the Dawei port in Myanmar, and generally there's a lot of appetite for Asian, especially Southeast Asian risk amongst the Japanese companies. So I think, and that is, in my view, an indirect, unintended perhaps consequence of Abenomics. As money, lots of money was printed, it was recycled, or the Japanese companies, instead of looking to address local demand, which still is weak, they're obviously exporting their capital to countries such as Indonesia, Thailand, Malaysia, where demand is much stronger. And it benefits all of them, because ultimately the corporate profits will be recycled, will be brought back to Japan, and of course you are connecting the dots around this fragmented region.
Now, I've sort of saved the best for last, or at least in terms of many investors' minds, Myanmar right now. Obviously a bit of a darling for the region, exciting market. Why is it such an attractive frontier market for foreign investors?
Well, Myanmar has really surpassed everyone's expectations. I remember 2 years ago when we went there with the delegation from the UK, the first one in 17 years, there was a lot of caution, a lot of hesitation about moving into yet another hot frontier market. The investors have learned that these new frontier markets can open up quickly and close down as well. Myanmar has been very steady and fast. If you look at these sectors such as telecoms, even banking and tourism and transportation, Myanmar has really outperformed people's expectations. We had the launch of new mobile licenses. Mm-hmm. In a matter of, I believe, 12 months, they managed to organize a tender. It took Thailand 10 years to achieve the same result. We have now flights, AirAsia flights going both to Yangon, to Mandalay, several flights from Bangkok, bringing thousands of tourists. Hotels are booming. You have Unilever already on the ground, Coca-Cola, perhaps 15 banks lining up to open their branch, and so on and so forth. It's really exciting. I always like to be cautiously optimistic, having witnessed some disappointments previously in countries such as Ukraine, even Turkey, and even Mongolia, some would argue. But I believe that Myanmar is more like more similar to Indonesia in its managed transition from above, admittedly by the same group of politicians who were in charge 5 years ago, but with a clear commitment and desire from both the people to get to the new stage and catch up quickly. Because for almost 45 years, the country has been denied economic benefits that the rest of us have been enjoying, around the world.
So you don't think that there's a risk in the reform that we've recently seen in Myanmar to be reversed?
In the way that investors define reversibility, i.e. going back to the same old regime, same old methods, and somehow closing the economy, putting the genie back in the bottle. No, I don't believe that is going to happen, and it's possible. I say that not because there is no risk of political instability. I say that not because the path is going to be smooth, but it's very clear that the people of Myanmar have come to expect progress. They've come to expect openness to trade. Businesses are thriving. And there is a very strong consensus in favor of moving forward economically. And that, in my mind, promises the Myanmar could actually deliver rate growth of maybe 10 to 12% per annum.
Okay. You touched on Ukraine. I want to kind of get your experience here, obviously. Born in Europe, educated in the UK. Does the situation there obviously have any ramifications on markets globally?
I like the way you make a distinction between Europe and UK. But
from the UK at this point.
I'm very worried about what's happening in Ukraine, obviously, having lived there during the Orange Revolution when hopes were high for transformation, for economic progress, for integration with Europe. And of course, this is a valuable lesson also for Asian politicians and elites, that you cannot ignore the wishes, the desires of the people. I think the Ukrainian situation is very specific. It's unique in many ways. It's a result, a consequence of historical circumstances, of cultural. But the bottom line is, my main concern when I look at Asia is the rising inequality of income. We talk about GDP growth, where we discuss, headline growth of 7 to 8%. But what's more important is income distribution. That Asia, including Southeast Asia, needs to start addressing the problems of welfare, of social justice, and inclusiveness. If it's not going to be addressed, we are going to see more unrest and political instability, which in the end could put brakes on economic growth.
Are there any countries within the region that are addressing some of those concerns you just mentioned?
No, I think all the countries are trying to address. They are certainly aware of the concerns, and there's been a lot of political unrest already, like we've seen in Thailand. The problem is it's obviously a vicious circle, because in order to have bigger welfare, you need to have new tax policy. You need to have a buy-in from the population on fiscal reform, on removing the subsidies, for instance, and then taking on some of the business groups and introducing higher taxes. And these are, of course, very unpopular, because politicians have to get elected. So democracy sometimes indeed is the worst enemy of social distribution. But I think the elites are definitely aware of it and addressing it. We are seeing signs of fiscal reform in Indonesia. Malaysia is now also trying to raise the fuel and energy cost. And indeed, the tax base is slowly being broadening, but probably not fast enough, and more will need to be done near term to address the issue.
Thank you, Paulius. This has been an exciting overview of emerging markets. If you're interested in more information on Myanmar, Indonesia, Malaysia, or more than 30 countries globally, please visit the Oxford Business Group website.